How do I get rich? It is perhaps the most searched, most obsessed over question in the history of modern finance. Yet, if you look around today, most of the answers you find are either lottery ticket, dreams, crypto moonshots and day trading schemes, or overly complex institutional strategies that feel impossible for the average person to start. The truth? Getting rich isn't about one lucky break. It's about repeatable habits and engineered systems that have worked for decades, and they still work right now in 2026. We are living through a unique economic era. We're dealing with the ripples of sticky inflation, shifting global tariffs, and energy prices that refuse to stay down. In an environment like this, the get-rich-quick noise is louder than ever, but the path to true wealth has actually become narrower and more disciplined. Today, I'm pulling back the curtain on the tested methods that actually move the needle. These are the same principles used by self-made millionaires and the quiet long-term investors who don't post their Ferraris on Instagram, but own their time and their lives. These aren't shortcuts. They are proven strategies that reward consistency above all else. If you are tired of the hustle culture fluff and want a mathematical, psychological, and practical roadmap to financial freedom, you're in the right place. Let's break down the pillars of wealth in 2026. The absolute, non-negotiable foundation of wealth is a simple math equation: spend less than you earn. It sounds boring, right? But in 2026, this is a radical act. We are constantly bombarded by targeted AI advertising designed to figure out exactly what we want before we even know it. The biggest silent killer of wealth is lifestyle creep. You get a 10% raise at work, and suddenly you feel you deserve a car with a higher monthly payment or a larger apartment. But here is the secret. When your income goes up, but your expenses stay flat, that gap is where your freedom is born. In a high inflation environment, living below your means means fighting for every dollar of that gap. Don't upgrade your lifestyle. Upgrade your brokerage account. The wider you can keep that gap, the faster the engine of compounding can start working for you. Most people approach savings like this. They get paid, they pay the rent, the utilities, the subscription services, the grocery bill, and then they see what's left over to save. Spoiler alert, nothing is ever left over. You have to flip the script. On payday, before a single bill is paid, you must automatically divert 15 to 20% of your gross income into your investment accounts. Treat this like a tax from the future version of you. If you never see the money in your checking account, you won't miss it. Automation removes the need for willpower, and in the world of finance, systems beat willpower every single time. You cannot fly if you're tethered to an anchor. Credit card debt at 20% or 25% APR is a financial emergency. There is no investment in the world, not the S&P 500, not even Bitcoin, that consistently returns 25% year after year. If you carry a balance on a credit card, you are effectively anti-investing. You are paying the bank the returns that you should be earning. The debt avalanche: pay off the highest interest rate first. This is mathematically the fastest way out. The debt snowball: pay the smallest balance first for the psychological win, pick a lane and run. Once that debt is gone, that monthly payment becomes found money that you can roll directly into your wealth-building machine. The 2026 Emergency Fund. We've seen how volatile the job market and the global economy can be. An emergency fund isn't just a savings account. It is liquidity. It is the ability to say no to a bad situation. In 2026, aim for 3 to 6 months of essential expenses. In a world of high interest rates, keep this in a high-yield savings account, HISA. You want your cash to at least keep pace with inflation while staying liquid. This fund is your insurance policy against life's unfun surprises: a medical bill, a sudden job loss, or a major home repair. When you have this cushion, you never have to sell your stocks during a market downturn just to pay for a new alternator. You stay in the game. If you want to get rich while you sleep, you have to own the productive capacity of the global economy. For 99% of people, the most effective way to do this is through low-cost, broad market index funds, or ETFs, specifically those that track the S&P 500, or the total stock market. Why? Because you aren't betting on one company. You are betting on human ingenuity and the growth of the top 500 companies in the world. In 2026, the cost of entry is lower than ever. You can start with $50. The magic formula is capital plus consistency plus time. If you invest $500 a month into a fund returning an average of 8-10% annually, in 30 years, you're looking at over $1 million. Most of that isn't even your money. It's the interest on the interest. Time in the market always beats timing the market. Aggressive income growth, the wealth accelerator. Saving is the defense, but increasing your income is the high-octane fuel. You can only cut your expenses so far. You can't spend less than zero, but your income potential is theoretically infinite. In 2026, the side hustle has evolved. With AI tools, you can now do the work of a 3-person agency by yourself. Whether it's specialized freelance consulting, a niche YouTube channel like this one, or a digital product business, you need multiple streams of income. Upskill. Become the person at your job who understands the latest technology. Negotiate. Don't settle for cost of living adjustments. Provide outsized value and demand outsized pay. Diversify. Never rely on a single paycheck. In the modern economy, a single point of failure is a massive risk. Rich people buy assets. Poor people buy liabilities that they think are assets. An asset is something that puts money into your pocket while you're at the beach. This includes dividend stocks, companies that pay you just for owning their shares. Real estate, rental income that pays down a mortgage while the property appreciates. Intellectual property, books, courses, or software that sell 24/7. Every time you get a windfall, a bonus, a tax refund, or a gift, ask yourself, is this going towards something that will pay me back or something that will cost me more money to maintain? It's not about what you make, it's about what you keep. In 2026, tax laws have shifted, and contribution limits for 401ks, IRAs, and HSAs have likely increased. If your employer offers a 401k match, that is a 100% guaranteed return on your money. You will not find that anywhere else on earth. Take it. Maximize your Roth IRA if you can, paying taxes on the seed now so you don't have to pay taxes on the harvest later is one of the greatest gifts you can give your future self. Also, don't sleep on the HSA health savings account. It's the only triple tax advantaged account in existence: tax-free in, tax-free growth, tax-free out for medical expenses. Wealth is 20% head knowledge and 80% behavior. The biggest hurdle to getting rich isn't the stock market, it's the person you see in the mirror every morning. The world in 2006 is designed to make you impulsive. Apps want your attention, stores want your credit card. Building wealth requires delayed gratification. It requires being okay with driving the older car while your neighbor leases a brand new SUV. It requires looking at a market crash not as a disaster, but as a clearance sale where everything is 20% off. This is the final stage of the wealth cycle. When your investments start making money, the temptation to spend those profits is immense. But the truly wealthy take those dividends, those rental profits, and those side hustle earnings, and they plow them back into more assets. This creates a snowball effect. Eventually, the snowball becomes so large that it moves on its own momentum. This is the point of financial independence, where the income from your assets covers your lifestyle. That is the definition of being rich. Getting rich isn't a mystery, and it's not reserved for the lucky. It is a slow, deliberate process of doing boring things remarkably well, over and over again. It's about living below your means, killing bad debt, investing in the total market, and constantly hunting for ways to increase your value to the world. In 2026, despite the headlines about inflation or economic shifts, these principles remain the true north of finance. The noise will change, the technology will change, but the math of compounding and the psychology of discipline never change. My challenge to you this week: don't try to do all 10 of these at once. Pick 2. Maybe it's setting up that 15% automatic transfer. Maybe it's finally calling a meeting to negotiate your salary. Or maybe it's just opening that high-yield savings account. Small, disciplined actions taken today create massive, unrecognizable results in 5 to 10 years. If this video gave you a clear path forward and cut through the confusion, do me a favor, hit that like button. It helps the algorithm share this practical advice with more people who need to hear it. Subscribe to CK Wealth Academy and turn on those notifications. We're going to keep diving deep into the technical and tactical side of building wealth in this new economy. Now, I want to hear from you. Which of these 10 methods are you going to focus on first? Are you tackling debt, or are you going on the offense with a new side hustle? Comment below. This content is for educational and informational purposes only. It is not personalized financial, investment, or tax advice. Always do your own research and consult with a qualified professional for your specific situation. Remember, past performance is never a guarantee of future results. Thanks for watching. Now, stop watching and go take action. Real wealth is built one disciplined step at a time. I'll see you in the next video.